Something important is happening beneath the surface of global financial markets. It is not a sudden crash or a single dramatic event. It is a slow, structural shift in the way investors think about money itself, what it is worth, who controls it, and whether it can still be trusted. The financial system we live inside is built on fiat currency, money that has value not because it is backed by anything tangible, but because governments say it does. That is, in the most literal sense, a system built on trust. And that trust has been wearing thin. Decades of reckless government spending, mounting debt, and the repeated use of money creation to paper over fiscal failures have left a growing number of investors questioning whether the promise still holds. That questioning has a name. It is called the debasement trade, and it is one of the most significant investment themes of this decade. Understanding it does not require an economics degree. It requires only a clear-eyed look at what governments around the world have been doing with their finances for the past 2 decades and what the logical consequences of those decisions are beginning to look like. Welcome back. We are Bitcoin Capital Gold. A global financial shift is underway, with Bitcoin and gold at the center. We track how institutional capital moves between them, understand that flow, and position with it. What is the debasement trade? Today's debasement works through government borrowing and money creation. When a government spends more than it collects in taxes, it borrows the difference by issuing bonds. When those bonds accumulate faster than the economy grows, the debt burden becomes structurally unmanageable. At that point, governments face a limited set of options: cut spending, raise taxes, default, or quietly inflate the debt away by printing money and allowing inflation to erode its real value. History shows that most governments, when faced with that choice, choose the last option. The debasement trade is investors' response to that pattern. It is a deliberate shift of capital away from currencies and cash, which lose value when money is printed, into assets with fixed or limited supply that cannot be debased by government decision. Gold has been the primary vehicle for this trade for centuries. Bitcoin is the newest entrant. Together, they are attracting a growing wave of institutional and individual capital as confidence in the purchasing power of major fiat currencies quietly erodes. The debt problem is not a theory, it is the balance sheet. The United States, Japan, and Europe are all carrying debt at levels that are difficult to service under normal conditions. In the US, annual interest payments on the national debt are now competing with the government's ability to fund essential services. In Japan, government debt has exceeded 250% of GDP, a level without precedent among major economies, forcing the Bank of Japan to hold interest rates near zero simply to keep that debt affordable. In Europe, the European Central Bank has repeatedly stepped in to buy government bonds and prevent yields from rising to levels that would expose the fragility of several member states' finances. Across all 3 blocks, the trajectory is the same. Debt accumulates, the cost of servicing it rises, and governments resist the politically painful choices required to genuinely address it. The purchasing power of the currencies they issue erodes slowly and continuously as a result. This is not a prediction, it is a description of what has already been happening, visible in the declining value of major currencies over any meaningful time horizon. Japan, the carry trade, and what it means for both assets. Japan is the most instructive live case study of the debasement trade in action. With government debt exceeding 250% of GDP, the Bank of Japan has held interest rates near zero for decades to keep that debt serviceable. The consequence has been persistent yen weakness, and that weakness created what investors call the carry trade. Global investors could borrow in yen at negligible cost, convert to other currencies, and deploy capital into higher-yielding assets, including Bitcoin. Cheap yen effectively became rocket fuel for risk assets. The carry trade has a sharp reversal risk. When the Bank of Japan signals rate rises or intervenes to support the yen, investors must buy yen back to repay their loans. To raise that cash quickly, they sell their most liquid holdings, and Bitcoin, trading 24 hours a day, becomes an immediate target. The result is sharp, rapid Bitcoin corrections that have nothing to do with Bitcoin's fundamentals. A Bitcoin sell-off driven by a Bank of Japan decision is a mechanical liquidity event, not a statement about Bitcoin's long-term value. The 2 timeframes carry entirely different logic. But Japan's yen weakness is no longer purely a carry trade story. It is increasingly a structural story. When Japanese government bond yields rise in a disorderly way as markets begin questioning whether a debt load of 250% of GDP is genuinely manageable, that signals something deeper than a policy adjustment. It signals eroding confidence in the fiscal foundations of one of the world's largest economies. In that environment, gold and Bitcoin, priced in yen, have both reached record levels. The market is saying clearly that holding yen is no longer a safe decision. Japan's situation matters because it is not unique, it is simply the furthest along. The same dynamic of unsustainable debt, suppressed rates, and gradual currency erosion exists in varying degrees across the US and Europe. Every country watching Japan's yield crisis is watching a potential preview of its own fiscal trajectory. That is the context in which the debasement trade is being taken increasingly seriously by mainstream investors. Gold's role in the debasement trade is not new, but the scale of institutional participation is. Central banks globally have been accumulating gold at historically elevated rates for several consecutive years, with official sector purchases exceeding 1,000 tons annually. These are the very institutions that issue and manage fiat currencies, quietly diversifying away from their own product. That is not a short-term trade. It is a multi-year strategic statement that gold's role as a reserve asset is growing, not diminishing. For investors, the logic is straightforward. Gold's supply grows at roughly 1 to 2% per year regardless of government decisions. No central bank can print it. In a world where paper money supply is expanding faster than real output, an asset with genuinely constrained supply holds its purchasing power over time. Gold's recent price performance is not speculation, it is a rational response to a fiscal environment where money held in cash or bonds is losing real value and gold is not. Bitcoin and the digital version of the same argument. Bitcoin's case rests on one verifiable fact: its supply is mathematically fixed at 21 million coins permanently by code that no government controls. Bitcoin was created in 2009 in the immediate aftermath of the global financial crisis, and its creator deliberately embedded a reference to government bank bailouts in the very first block of transactions. It was designed as an explicit alternative to a system that expands money supply to absorb its own failures. In a world where governments are doing exactly that, the fixed supply is not a footnote, it is the entire argument. For most of its early life, that argument was dismissed as ideology. That is changing, driven by institutions, not retail. Regulated Bitcoin ETFs have lowered the barrier between traditional finance and Bitcoin exposure. Pension funds, endowments, and major asset managers can now access it through familiar regulated structures. Bitcoin priced in yen has reached record levels as Japan's currency has deteriorated. The same has played out in the Turkish lira, Argentine peso, and Nigerian naira. In each case, those who held Bitcoin retained significantly more purchasing power than those who held local currency. Japan's significance extends further still. Japan holds approximately $1.13 trillion in U.S. Treasury bonds, one of the largest foreign holdings of U.S. government debt in the world. If Japan were forced by its own fiscal pressures to sell a meaningful portion of those holdings, bond supply would increase, yields would rise, and the dollar would weaken. A weaker dollar historically makes Bitcoin more attractive as an alternative store of value for a global investor base looking to reduce dollar exposure. Japan's fiscal crisis is not a domestic story. Its ripple effects reach directly into the case for Bitcoin. What a supercycle would look like. A supercycle in the context of gold and Bitcoin is not simply a large price increase, it is a sustained, multi-year repricing of both assets driven by a fundamental shift in how a large portion of global capital is allocated, away from fiat instruments and towards hard assets with fixed or limited supply that cannot be debased by government decision. Supercycles are not driven by speculation, they are driven by structural change in the investment universe. Several conditions that historically preceded such cycles are currently present simultaneously.
Sovereign debt levels in major economies are at or near historical highs. The political appetite for genuine fiscal adjustment is low across most major democracies. Interest rates, having risen sharply to combat post-pandemic inflation, are creating new strains in government budgets as debt refinancing costs increase. And the institutional infrastructure for Bitcoin investment, ETFs, custody solutions, regulatory frameworks, has matured to the point where large-scale capital allocation is now practically achievable in a way that it was not 5 years ago. The trigger for a supercycle is typically not a single dramatic event. It is the accumulation of evidence that the existing system is not self-correcting, that the debt trajectory is not reversing, that currency debasement is structural rather than temporary, and that alternatives must be taken seriously as permanent portfolio allocations rather than speculative positions. Each year that the fiscal picture deteriorates without meaningful adjustment adds to that accumulating case.
Gold and Bitcoin are not the same asset, and they do not serve identical purposes in a portfolio. Gold is a multi-thousand-year store of value with deep liquidity, central bank credibility, and low volatility relative to Bitcoin. Bitcoin is a newer, more volatile, more asymmetric asset with a fixed supply and a growing institutional footprint. In the debasement trade, they are complementary rather than competing. Gold provides stability and credibility. Bitcoin provides asymmetric upside if its adoption as a mainstream reserve asset continues to accelerate. The bottom line: the debasement trade is not a fringe theory. It is a rational, evidence-based response to observable fiscal realities in the world's largest economies. Governments are borrowing at levels that are historically unprecedented in peacetime. The monetary consequences of managing that debt, currency expansion, inflation, and gradual purchasing power erosion are already visible in the price of real assets over the past decade. Gold has been reflecting this for years. Bitcoin is increasingly reflecting it as institutional adoption deepens. Whether this builds into a true supercycle, a multi-year structural repricing of hard assets relative to fiat currencies, depends on whether the fiscal trajectory of major economies improves or deteriorates. The current evidence points toward deterioration. Debt levels are rising. Political constraints on adjustment are high. The institutional case for Bitcoin and gold as portfolio necessities rather than speculative additions is strengthening quarter by quarter. The debasement trade is not a bet that the financial system collapses. It is a bet that it continues exactly as it has been, and that the logical consequence of that continuation is a world in which money that cannot be printed holds its value, and money that can be printed loses it. That is not a radical prediction. It is a description of what has already been happening. Bitcoin and gold are simply the clearest expression of the investor response to it. If you found this analysis useful, consider liking and subscribing so you don't miss our next video. Do you think the debasement trade is the defining investment theme of this decade? Share your thoughts in the comments. We read every one. At the heart of the new global financial economy will be Bitcoin and gold. If you want to be ahead of the curve, follow this channel.